Good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. We're coming to you from a very toasty Palm Springs in the greater Coachella Valley area. We're supposed to peak out at 116 today. And with that, I think this is the epitome of a dry heat, 8% humidity. So imagine that 116 is going to be our high temperature today with an 8 degrees for humidity. So that very much is a dry heat. So, but we're doing fine here, and we're going to have a cool off trend next week. We'll be back in the low hundreds. In fact, maybe even under 105 late next week. So we'll look forward to that. Might need a sweater. We'll go ahead and jump right into our program in terms of what we do first. We're going to show you our rate grid right off our website so you can get an indication where interest rates are at. Again, not much of a change. We continue to be in the sixes, the low end of the sixes across all program types. Again, FHA, VA just under the 6% threshold, and the jumbos are actually looking pretty good. In particular, by the way, the equity loans, especially fixed rate equity loans, what we call HE loans, rates on those are actually very good right now, especially if you can tolerate a 20-year term. You're seeing some rates that can be very low sevens, and if you're willing to pay a point in origination, you can actually get one of these under 7%. So keep that in mind if you've been thinking about getting an equity loan. Rates on those are actually very good right now, especially on the HE loans. Jeff's going to pull up the 10-year bond yield chart. Interesting curve here. Again, this chart goes from last Friday through today, and you can see how it kind of ended last week low, climbed up first couple of days, even through the Wednesday that Jeff usually likes to see a dip. Did not happen, but it happened today. So nice to see we're back down to the 434 range just a couple of days ago at the top of that chart in the midweek, that mid range. We were, about 10 basis points higher, about 4.44, 4.45. So it's nice to see it come back down to that level. And that's, again, why rates continue to be where they've actually been really for a pretty long period of time now, which is, again, I think a good thing. As to what's going on in the markets to get us where we're at right now, what's been moving markets around, well, very light economic data this week. I mean, very light. I did throw up here one thing that I thought might be of interest: the National Federation of Independent Business. They do a survey of small business owners, and small business optimism is actually remained steady. So the sort of the message there is, despite all this tariff talk about how terrible these tariffs are going to be and ruin the economy, et cetera, so far small businesses aren't feeling the pain. They're pretty optimistic. So that was a little bit of a surprise. The next thing was consumer credit. We don't talk about that much, although we have mentioned in the past how credit card debt has exploded. It's over $1 trillion. Well, consumer credit in May actually only rose by $5 billion. That was quite a drop from the previous month and half of what was predicted to occur in May. So that's a sign that maybe the economy is weakening up just a hair in terms of consumer spending. Obviously, consumer credit is a good measure of consumer spending, but whether or not that's indicating a really softening economy, we don't see that in the labor numbers yet. So we'll have to see how that goes. The biggest item this week is the release of the Federal Open Market Committee minutes for the June meeting. Basically, what came out of that was a couple of things. There's some disagreement among the Fed members about whether to start rate cuts as early as this month. And even though there is good evidence that we're very near the Fed target on inflation, basically the conclusion of the meeting was, well, we're getting close and we're open to a reduction. We're going to hold off because we're worried about what could happen with the tariffs once they flow through the economy. Part of the thinking is, yes, right now the tariff issues haven't shown up in the numbers in terms of inflation because companies are just absorbing the hit, absorbing the extra cost of the tariffs through their profits, but that's being considered temporary, so they don't think it's going to last. So for that reason, as well as others, they think inflation could snap back because of the tariffs. So interestingly, the Fed's basically saying we're probably going to hold steady because of what we think may happen, and that's kind of an odd stance to take for a group, an agency that should be looking at the data and really reacting to that data today, not what they think it's going to be some number of months. But anyway, that's my 2 cents on the markets and why we're at where we're at. So at best, we're looking at maybe 2 quarter point increases, I'm sorry, decreases this year. But if so, it looks like it's not going to be starting in July. So with that, Jeff's going to go ahead and bring up the next slide as he started to do there. We're going to talk about a little bit of what to do for buyers in today's high rate, low inventory market. And first couple of bullets there you can see kind of describes the current situation. Although I'm going to give you a couple of caveats to this. Mortgage rates remain, high or elevated as they call it, 6.5%, 7%. That's not really historically elevated or high. You may remember several months ago we did a talk about the mortgage affordability rate index, or mortgage rate affordability index, MRAI. And what that did is it measured interest rates over the last 50 years and established that our current rate levels in the sixes are historically affordable by quite a bit, because the average mortgage rate in the country over the last 50 years is about 7.7. So we're actually at a pretty good level for mortgage rates. I keep saying it's about the home prices, not the mortgage rates. As to inventory, yes, inventory overall is tight. That's why even as we've seen these rates go up the last couple of years, home values have continued to creep up despite that, and despite predictions otherwise because of rates snapping up. But still within certain markets, even though overall both statewide, countywide, countrywide inventory, there's not enough homes available for the buyer demand. Within markets, we're seeing some shift in inventory where it's getting closer to normal, 4, 5, 6 months of supply. So actually, there's been a little bit of shift in inventory, enough so that there's been a bit of a shift in terms of who's got the leverage in terms of a real estate purchase transaction, buyer or seller. I would say right now it's moving a little bit toward the buyer. And there's a lot of competition now, if you're a seller, a lot more than there was 3, 4, 5 months ago because of that increased inventory. I think all sellers need to be recognizing that. And then because of that increase in inventory, those buyers who are still kind of scarce, I think a few more need to come out, start looking what's out there, because there's more out there now than there was earlier. And I think you may have some leverage to negotiate some concessions. And again, I argue always try to do that with getting seller credits to apply towards your cost. So what other talking points can we talk about as to this subject? Mortgage rate trends. Well, it's kind of interesting. I've just talked about how the fact that historically our rates are pretty darn good. They are affordable. It doesn't feel like it. I blame the house price, not necessarily rates themselves. The impact on affordability, of course, is there when we had a slew of people buying homes just 5 years ago where their payments were about half of what they would be now for the same loan amount. Obviously, there's an affordability issue there. But as I just commented on, as we see in some markets, including ours here, where some inventory locally is starting to grow, there's an opportunity, and we're seeing it, and some of the transactions we're handling now reflect this. People are able to go out, negotiate a pretty good deal on a purchase, get some concession. For example, I think in the Palm Springs market right now, the average home sells at about 97% of the list price. Well, there you go. That's 3%. Why wouldn't you start with, if you like a home and you want to try to get a concession, submit an offer. I say submit a full price offer and then ask for that 3% as a seller credit. We can show you how to use that towards your loan if you're getting a loan, of course. Another talking point to consider is, let's talk about if you're a first-time home buyer and you're trying to budget, what kind of level the housing expense, really, the house payment, you'll call it, housing expense, principal, interest, taxes, insurance, HOA dues, if that's applicable. You need to start budgeting for what amount for that you can afford in your budget. And of course, on this screen here, we have what has been historically considered an average percentage, somewhere in the range of 28 to 31% of your income. Way back when it was 28%. And what that meant was 28% of your gross income could be or should be allocated for your housing expense, including taxes, insurance, HOA dues, as well as the principal and interest. Over time, those numbers changed. That ratio, which we call a top ratio or housing ratio, shifted to where in more recent years, 33% was considered an acceptable target. So that's why, on average, over several years ago, and even more currently, 28 to 31% is what should be considered in terms of your budget. Now, again, that is always calculated off of gross income. So if you're a wage earner, in terms of how the loan's made, it's going to be based, 28 to 31% of your gross earnings, your gross wages, not your net take-home pay. What gets confusing is if you're self-employed, those ratios have to be met on the housing ratio. If you are self-employed, it's going to be off your net income, not your gross revenue to your business. That's an important distinction to keep in mind, and why more self-employed people have a more difficult time getting qualified. Another thing to think about, given that we're just talking about the debt ratios, especially the housing ratio where you need to be, a very good idea is to go ahead and get pre-approved, pre-qualified, as well as pre-approved. First of all, we're going to help you identify if you meet a 28 to 31% housing ratio for a particular price level you're interested in, or if you're not sure, we can tell you how high you can go in price and be able to meet that target range for your housing expense so you're at a comfortable level. We can take it a step further, though. We can get all your documentation. We can submit your file and get formal underwriting done based solely on getting a property at some point. So it's what we call TBD underwriting, to be determined. This is a great way to get fully underwritten and approved, not just a pre-approval, fully underwritten by a lender, pre-approved, written approval, basically says we only need the appraisal and some escrow and title items. You're ready to close. That can help you negotiate a better deal because you can close more quickly. You can demonstrate you're not just pre-approved, but fully underwritten and approved. That can make a big difference in your offer. So keep that in mind. And that's the next bullet point, actually. I got ahead of myself. It gives you some competitive offer tactics. You can show you've already been pre-approved fully by a lender. That can allow you not to have to wait 30 days to close escrow. You can close maybe in 21 days, maybe possibly even 15. Appraisals are not taking that long right now. So that is why getting a full pre-approval, full underwriting approval subject to a property can be extremely good for you in terms of negotiating your offer. It can help reduce the contingency time on the loan, or if you have a pre-approval fully from a lender, you could consider waiving the loan contingency or basically clearing it because you're already underwritten and approved. What you could leave in place perhaps is the appraisal contingency because you're going to, of course, your transaction is going to be subject to finding that house and then being able to close. So that's just one idea about how to use a pre-approval in negotiating a better offer to get that home. And of course, this helps you too, competing with cash buyers, because you have that one extra step in the process closer to being able to close quickly. Now, in terms of flexible loan products, yeah, there's some out there. We've been getting more interest, more indications or inquiries about ARM loans, adjustable rate mortgages. Right now, really, those are not priced out that well relative to 30-year fix. That's been the case now for several years. Some jumbo programs, there's a little bit of a rate advantage, but not a great deal. On conforming loan amounts, very, very little as to ARM loans that are competitive on rate. So I think we are still pretty much in a fixed rate environment, but here's where you can use that seller concession I mentioned earlier. Try to get some seller credit. We use that towards your loan, not just in closing costs, but in either permanently buying down to the rate. I just quoted somebody a 30-year fix at 4 7/8 using a seller credit from the home builder in order to get that paid for by the builder's credit given to the buyer. So that's a good example. Or of course, the 2-1s and the 3-2-1 buy downs that we've talked about before in the program. So those are the ways we try to provide some more flexibility on the type of loan programs you can use to get that offer accepted. So those are the kind of strategies we think you should consider in this current environment. And if you need any more help with that, feel free to call me. Love to have a conversation, and then I can give you specific numbers to help you get to that destination that you're looking for.
Hey, Art, I just had a couple of follow-up questions with that, if you don't mind. I'm gonna play as if I'm the buyer. It's like, okay, knowing these strategies, what kind of things would you help me understand to get me prepared to say, hey, this is my best way forward?
Well, yeah, that's interesting because that's really gets to the heart of the initial pre-qualification process, where a lot of that is some back and forth. It's almost like I'm going to start off by interviewing the prospective buyer and try to understand better what their need what well there's what their needs are, what their wants are, and what they can do, in between those two things. Because sometimes what they need, maybe they aren't going to be able to get it. It can get a little tricky. So you go through this interviewing process and learn as much about them as we can in terms of, where's the biggest issue or concern that they're going to have. Is it going to be do they have enough money to buy the home in terms of down payment and closing costs? Or are they more concerned about monthly payment? Maybe they have a good amount of cash somehow, but they're more concerned about the level of payment that they're going to incur. Because you have, families out there who will tell us, look, I want to buy a house, and I even have what I think is a good amount of money for down payment, but I don't want to be married to my house payment. So, we encounter, a good amount of people who, on the income side, have good income, and we can tell them, hey, on paper, you can qualify for $7,000 a month for housing expense, all in. And they'll say, well, no. Yeah, thanks, but no thanks. We want to go to 4,500. And then they have to realize what comes with that number in terms of the kind of house, the kind of property that they're going to have, maybe have their eyes on. Sometimes there's a disconnect there. And so we have to help them kind of bridge that and find somewhere in between that they're going to be happy.
Does that tend to come from people that have been out of the buying scene for a while? Like maybe that's the first home they've ever looked at buying, or they haven't bought a home in 10 years and they kind of have a unreally realistic expectation?
Well, I was just going to say where that comes in is either, someone who hasn't bought a home in quite a few years, or someone who's never bought a home, they're a first timer. So both ends of that spectrum, that's where you run into this sometimes. And that can be a challenge because, and we've talked about this on the show before, where, this whole issue about being a renter and your opportunities for building wealth versus being a homeowner. And, we run into some folks who are renters. They're young, make a lot of money. They're renters. So they haven't saved up a lot of money. And then that can sometimes be the kind of buyer profile that if I'm pre-qualifying, and maybe even we're going to go the step of getting them pre-approved, where they may say, look, yes, we're very fortunate between the two of us, we're 28 years old and we make $300,000 a year, but we do not want the kind of mortgage expense, the housing expense that you're telling us as the professional, the book says we can afford. We don't want to do that, so we're willing, we're going to resist going to the max. We want to be at this lower level that we're probably overqualified for. And then, of course, we go from that point of, okay, fine, here's what the loan amount's going to be. And we'll take that, add it to what your down payment you say you have, and put all that together. And here's your price level that you want to stay at, even though we say you can go higher. And so then they have to reconcile what kind of house they're going to get at their number versus what we say the book says they can actually afford.
Is it uncommon, and this is my last question, is it uncommon for someone that maybe is coming out of a renting situation to have that mindset, who thinks the next step in their home ownership, maybe it's not a single family standalone property, maybe it's a condominium, or is that even more challenging?
Well, it can be more challenging because that sometimes is the thought process is, well, I won't buy a single family home. They're too expensive. I'll look at a condo, because the thinking is a condo, and it's true, on average, a condo is going to have a likely lower price level for a given amount of bedrooms and bathrooms and maybe even square footage. But as I say, there's always a but. And with a condo, the little secret surprise, if you will, is, of that condo that might be, $75,000 less than a single family home that you're looking at, or maybe $100,000 less. Well, that's why you're looking at the condo. But then you got to realize, well, if that single family home has no HOA dues, but you're going to get this condo that's 100,000 less with 500 a month in HOA dues, well, suddenly, from an affordability standpoint, from a housing expense standpoint, those two are not nearly as far apart as it would seem, because the HOA dues, $500 in HOA dues is worth tens of thousands of dollars in loan amount and therefore price. So that's one of those issues that we end up playing the role of, kind of enlightening the person who doesn't think that through. And then they're back to, well, gee, if it's going to cost me almost as much for a condo as a single family home, then I'm back to, we got to find a single family home and maybe try harder in finding something that we can get a more attractive price or extract more concessions so we can put it against our loan to help us afford it more. That's where we come in and try to help them strategize and come up with a financial solution to kind of bridge all of those kind of competing factors that sometimes are not in unison. So
it makes me have one additional follow-up question is, if I were someone who, let's say I'm starting out, and I'm qualified, my wife and I make the money, is it a wise play to consider maybe buying like a duplex or triplex and living in one of them?
Absolutely. In fact, that's something I try to bring up, especially if I'm dealing with someone who's a first-time home buyer, relatively young. It's a great way to kind of go after a couple of goals or potential opportunities. For one, at some point, although there's all the jokes about there's 35-year-olds, on everybody's couches, not getting out of the house, but there are a lot of younger folks out there that would like to buy a home, and they're a little frustrated about everything. And one of the things we try to bring up is try to kill two birds with one stone. If you'd like to buy a home, for purposes of basic shelter, okay, obviously that's one of the primary reasons you would buy. But consider this, and maybe you'd like to also consider potential real estate investments, like real estate as an investment opportunity. Plus, would you like a way for additional cash flow to help your overall mortgage expense for a property? Well, obviously the answer is a duplex, a triplex, a fourplex. Find one of those. Maybe you're young, you're single, you got a good job, you're making lots of money. Find a duplex or a triplex. Go after that. You can get an FHA loan on a duplex, triplex, fourplex with 3.5% down.
Wow.
As long as you live in one of the units. So you don't need very much money to buy, a 3-unit building that, you try to find a nice one that you're willing to live in one, right? You live in one of them, you're generating rental income from the other two. Your overall housing expense for yourself personally has gone down quite a bit. You've got the potential that after some period of time, you can then move out of that triplex, run out the third unit. Now you've got a fully cash flowed investment property, and then you're moving up to a bigger, nicer, maybe at that point, single family home. You're starting a family, etc. I mean, to me, it's a great springboard for first-time home buyers, younger ones. Even if you're 32 and you're on your parents' couch, time to get out. That's a great opportunity to get into home ownership and diversify. You need shelter, and you have your first step in a real estate investment portfolio. I think it's a great option that's underutilized.
I like that. Well, Art, thank you very much. I'll turn it back over to you.
Okay. All right, thanks, Jeff. And now we're going to talk about little bit different subject, and that goes into, and I know we've been talking about it a fair amount, is the reverse mortgages. And again, I want to kind of demystify a few things about reverse mortgages, what seniors really need to know. The first thing to do is make it, at least bring up the fact that it's odd, but reverse mortgages continue to be underutilized by the number of eligible seniors there are who could take advantage of this program. There is so many homeowners out there who are eligible, and they just don't understand the benefits, and they're still caught up on misconceptions, particularly as it relates to things that they really shouldn't be worried about it. It creates a lot of hesitancy. They're just afraid to move forward. So I want to kind of go over that again. I know we've talked about it before. So again, here's some talking points to consider. The first thing is, let me go over the basics again. A reverse mortgage, at least the core product in the U.S., it's called a HECM, Home Equity Conversion Mortgage. It is an FHA loan product, so it is administered by the Department of Housing and Urban Developments. The fundamental idea with a reverse mortgage is very simple. It's a mortgage like any other, but there's no monthly payments because you're not required to make them, but you can if you want. And if you choose not to make the payment, then interest does accrue. The loan will grow over time. That's the basic structure of a reverse mortgage, including the primary one used, which is a HECM. Now, there's, again, these myths about HECMs that's really frustrating to get over. One is the concern that what happens, you lose your home if the balance grows over the value of your home. That's not true. You can continue to stay in your home even if you have negative value. And at the time you pass away, if there is a negative value, your heirs will not be responsible. That negative value is absorbed by the lender, because what happens is after you pass and that loan gets paid off, and if it's paid off for less than what was owed, the lender then can submit a claim to HUD and get reimbursed for their loss. That's the purpose of the mortgage insurance that we have on reverse mortgages. And the other thing about the reverse mortgage in terms of myths, it doesn't mean the government owns your home. The lender doesn't own your home. You own your home just like you do now. If you have a small mortgage, you're a 7-year-old homeowner, you have a small mortgage in your house now. A reverse mortgage, if you get one to pay off your existing traditional first mortgage, it's just a secured mortgage, just like your current one. You still own it. The government doesn't own it. The lender doesn't own it. It's a great way, reverse mortgage is, to help you stay in your home and age in place rather than having to move. So that is something you really ought to consider in terms of quality of life. The other thing about a reverse mortgage, the HECM in particular, is the number of ways you can access your funds. You don't just get the loan and you get a bunch of money all at once and you're done. You have choices. That's part of the beauty of the program. When you get a HECM reverse mortgage, you can take some as a lump sum. You can take some for a specified period of time, like 10 years or 20 years, where you just draw the money out in the form of a monthly payment. You can draw the money out monthly through a 10-year schedule. That's not 10-year as in, having tenure at a college. That essentially is a fancy word for lifetime payments. So you can choose to get your money that way. Or you can choose to set up a line of credit. And you can even choose a combination of those 4 options when you get the loan. So that's very interesting and unique about the product that I think a lot of folks don't realize, which if they understood that, they would, I think, be less afraid of the product and realize it can give you so many benefits because of the ways you can access the money, in particular the line of credit. The other thing about the program is, eligibility and requirements. You have to be at least 62. Understand that that's the minimum age of eligibility, and the amount of money you can get at that minimum age is not going to be probably as high as you expect. You're going to generally think that if you're 62, you got plenty of equity, maybe even free and clear. But even at 62, the loan amount you're going to get is likely going to be maybe somewhere around 15 to 20% of the value of the home. It's going to be pretty small. A lot of times folks are a little bit unhappy about the amount available, but the idea is to protect you, because again, if you're not making payments, which most homeowners choose not to, that loan's going to grow over time. So there is some effort to make sure that as it grows over time, that the appreciation of your home value is also growing over time. The proposals that we provide to you assume a 4% appreciation rate, which I think is historically a good number to use. And so the idea is, as you get older is where you'll get more loan amount. But even when you hit 80, 85, 90, where you're getting past average life expectancy, even then probably the max loan amount you're going to get as to the value of your home is maybe 50, a little bit higher than 50%. So you do want to keep that in mind and realize that is the extent to which you can get pull equity out of that property. And again, partly is to protect you and your heirs in terms of that loan growing too fast. Now, there is some counseling involved with this product That's in part to make sure you understand all of these details, all the mechanics of the loan. And in addition, we spend a lot of time when we issue the proposal package going over it with the client in detail to make sure they understand it fully, and we answer all their questions. We want to make sure you're fully comfortable with the product before we move forward and get you through the process and achieve your goals with the program. The other thing I would say that I think I covered everything. Other things, one other thing I would mention, of course, pros and cons we already talked about. No monthly payments. You'll have more equity left, especially if you're younger when you start. And you'll have, in terms of impact on your heirs, in most cases, your heirs are still going to benefit from getting some amount of proceeds from the home once you pass. And again, your heirs at the same time are protected. If the value of the home is less than your loan balance when you pass, they will not have to be responsible for that. That is covered by the lender. That's, again, why the mortgage insurance there is in place. Anyway, that's basically how it works. I want you to just understand there's not really much mystery here once you fully understand the details. Hey, Jeff.
Hey, I have another follow-up question here.
Okay.
I'm thinking about those people who are trying to buy their first home. If my parents are over 62, they own their home, whether it's free or clear, whatever it might be, but they can qualify for a reverse mortgage or a HECM loan. If they took out that money, can they lend that money to me as a down payment at that 3% if I decided to buy let's say, a multifamily home?
Absolutely. I mean, see, that's the beauty of the reverse mortgage.
To get me off the couch, if you will.
Well, exactly. I see where you're going with it. Well, that's the whole idea is, with a reverse mortgage, when that homeowner, the parents, take that loan out of their home, and maybe it was free and clear when they did that. And yeah, let's say he's, they 62, 63, 64, maybe they have a $800,000 home. It's free and clear. They could probably get 200,000 out. So then, what they do with that is pretty much up to them. They can do anything they want with it as long as it's not illegal. So, if they want to give that or most of it to their child or children to buy their first home, and yeah, maybe they do what we just described, where it's not just a single family home or a condo. It's like, go big, go look for an investment property that can also serve to house yourself for some number of years. And that's your springboard into investment real estate. So to me, that's sort of a really good, in fact, we should come up with a seminar on, how to do that or something, because, to me, it's a really good way for a younger person to get into, real estate, again, shelter for themselves, and that platform for, having investment real estate in their, part of their assets. So
I think it makes great sense. And I'm just curious, again, you said there's really no restriction as long as it's not illegal, what someone gets some money from a reverse mortgage that they can do with that. So if they want to invest it, if they want to buy rental property or investment, whatever, they can do that with it.
Well, yeah. And one thing I would point out, because we do get this question from senior homeowners, because sometimes part of what they're getting money for is maybe the gift to a family member, children, what have you, is they get a little bit concerned about triggering gift tax. How much can I give to my child or my brother or sister, whatever, my parent, in terms of, gift for, buying a home and so forth. Of course, we're not accountants. We can't give tax advice. We always suggest you got to talk to your tax advisor, your CPA. What I think I know, and I qualify this with talk to your tax professional. I think what they'll find is the kind of numbers we're talking about in most cases aren't going to trigger any immediate tax liability. There's a whole formula involved. Again, your CPA, your tax preparer can explain it to you, where the numbers, the threshold you have to get to is pretty high before you have to worry about that. So, but that comes up sometimes as a concern.
Great. Thank you. I'm out.
Okay. And then the next thing I want to mention real quick here before we finish up is HECM for Purchase. That's a home equity conversion mortgage, the FHA reverse mortgage program. It can be used for a senior to buy a home. I'm actually handling one of these right now. And it's gaining more traction. Of course, as we all know, some folks complain about it. We have a big baby boomer population, and of course, they've eaten up all the homes. But you know what? A lot of those folks, I think, are getting older. You're going to start to see them downsize, and that provides opportunity as they downsize. and they're fully retiring, the HECM for purchase can be a great tool to meet that opportunity. And let me give you a perfect real life example. I've got a guy who I just sent a proposal out. He is selling a property in Wisconsin, and he's going to move to the Palm Springs area. He's expecting about $450,000 of proceeds. He's 67 years old. He is interested in using a HECM reverse mortgage as the purchase loan. We prepared the proposal, sent it to him. Remember I said for 600, for somebody who's younger on the age scale, closer to 62, you're going to get less. Well, in his case, turns out it works pretty much perfectly. For $450,000 that he would use in proceeds toward the purchase, at his age, he can get a HECM reverse mortgage loan amount of about $200,000. So this is going to allow him to buy a home for about $650,000 here in the Palm Springs area. That is a buying down in value situation. His home in Wisconsin was worth more. So he's buying down in value, relocating here to California in the Palm Springs area. He'll use his $450,000 sale proceeds, get a $200,000 HECM reverse mortgage, and he'll be able to, of course, then live in that home without having to have any mortgage payments at all. So basically, that's how it works. That's essentially the structure. As you know, the Jeff pulled up the bullet point there. You have to bring in the difference as cash. The 450 in the example I just described, that's the down payment. The HECM loan amount is $200,000, and therefore, when you close, you got a home with a $200,000 mortgage on it. You bought it for $650, so you're starting off with that $450 in equity, and but you don't have to make a payment on that loan unless you want to. Again, can't stress enough. You can make a payment if you want to, if you don't want to have that interest accrue. But in his case, he had no heirs. He's not concerned about that. He wanted no payment. So again, benefits, somebody who's downsizing, like my current client, he is relocating, not for family or care, but relocating here to Palm Springs is considered, of course, a retirement community. And of course, transitioning to accessible retirement homes is a good use of the reverse mortgage, not in this particular case, but it's another very common use for this loan product. And it can also depend on the financial, when we talk about financial dynamics, what we're talking about there is a couple of things. First, what I just described in terms of the loan amount you can get based on your age, but also when you get one of these loans, you are going to go through financial assessment, so that can have some impact on your available proceeds from the loan. If it's determined through financial assessment, you're going to need help in maintaining certain property-related expenses, such as property taxes, homeowners insurance, HOA dues, maintenance and repairs. So in some cases, the financial assessment may determine you'll have to get what we call a LISA, life expectancy set aside. So that's where some of the proceeds are pulled out of the loan and set aside, kind of like an impound account for taxes and insurance. And then that money is drawn on, again, to maintain taxes, insurance, and so forth. So in that case, we have to take into account that can affect your proceeds that are going to be available for you, and that could increase the amount of down payment when you're using this product for a purchase transaction. Again, the pro is no monthly payments. You are going to see some impact on your real estate equity over time, but in a majority of cases, that home survives positive equity even at the point the homeowner passes, but each case is different. And again, you'll get a full proposal year by year up to age 100 that would show you the relative growth of the HECM reverse mortgage with no payments being made versus the appreciation in your home value using a 4% rate as the average. So you can see how the difference in equity changes over time. So that's fully disclosed. And of course, we're there to answer all your questions about that. So again, if you're interested in this, we'd be happy to put a proposal together for you, and then we can talk about next steps, including counseling and so forth. Hi, Jeff.
Hey, Art, just one quick clarification. So in your example, the gentleman netted proceeds from his sale in Wisconsin of $450,000. He came over and bought then in Palm Springs, and he used the $450 as a down payment. Then he used a HECM and got back $200,000. Is that correct?
Yeah, it's basically the same as, let's forget about HECM for a second and just say, and this happens. I got somebody who comes in and says, I'm going to buy a $650,000 house. I sold my house in Wisconsin. I got 450. I'm going to put that all down. I want a $200,000 loan. That's normal every day. We all understand what that means, right? And then what happens is everybody gets flustered when we say a reverse mortgage to purchase a home. It's the same exact thing. You see a home for 650. You just sold your home in Wisconsin. You got 450 in your hand. You want a $200,000 loan. In your case, we do have to go through the calculations based on your age, what's actually available. In this case, it was 200,000 available. So he's buying this home with his 450 cash and a $200,000 mortgage. It just means, but in this case, that mortgage is a reverse mortgage, not a traditional, what we call forward mortgage.
So he never got any cash. He didn't get $200,000 back. He just got a mortgage that if he chose to not to ever have to make a payment on.
Correct. That's the key difference. And Jeff, you bring up a very good point. That's a key difference for anybody who's looking to use a HECM for purchase. Because with that scenario, your intent is you're going to have a certain amount of cash you want to put toward the property. You're hopeful that based on your age, you can get enough HECM reverse mortgage amount that when added to your cash, you're going to get to the purchase price that you desire. And that way you can close on that purchase price, on that home for that purchase price. And you'll have a mortgage in place, but you don't have to make payments on it. But you have to also understand with that mortgage in place that was used for the purchase, those other access options we talked about earlier are not there. They're gone.
Gotcha.
You can't set up monthly payments for 10 years. You can't set up monthly payments for lifetime. You can't set up a line of credit because you already used it all for the purchase. So your sole benefit on a purchase HECM is purchasing the home, getting a mortgage to cover the shortfall between your down payment, your cash money, and the price of the home, and be able to bridge that gap, but not trigger a mortgage payment you have to make.
It's almost a feeling, Art, and I know the numbers are not exactly this, but it's almost like, hey, he just came out here and bought a $650,000 home for $450,000, even though he still has a loan on it, but he's not obligated to pay on that.
Exactly right. That's right.
That's a beautiful strategy.
And for senior homeowners, sometimes what happens is they have unrealistic expectation on what they're going to get out of the sale of their other home, whether it's in another state or LA or Orange County or San Francisco and so forth. And maybe they already had their minds made up on a certain price level in another market like ours, and they get their home finally sold, and it's like, whoops, we're 300,000 short of what we thought we were going to get because this place in Palm Springs, we were going to pay cash, and now we can't. But we're 78 years old, and luckily, that 300,000 gap we can make up by reverse mortgage, so we still feel like we got it for cash because we're not making a payment.
I think
that's the way to think about it.
That's a beautiful strategy, and I tell you what, we've done a lot of shows, Art, and I don't think I've ever heard you explain it this way to buy a home. Is this new?
No, that's the point. Is it's here. It's been here. It's an option that's readily available, and we do have people who use them. Again, I've got a guy, the guy I mentioned in this show. He's looking at houses right now, so it's there, and we're trying to get the word out that this is a great opportunity for a senior homeowner who's because there's a lot of them out there. There's wherever they worked and lived for 30, 40 years, are selling everything. They're moving to a retirement area. They're downsizing. They prefer pay cash or at least not have a mortgage payment, because that's the other thing. You may decide to buy and you want all cash, and you can find a home you like all cash, but then the reverse mortgage, what does it do or could do for you? You say, okay, well, wait a minute. I like these homes I can buy for $1.2 million, but I don't want to go to $1.5 million because I don't have enough to pay cash. Well, buy $1.5 million and get a reverse mortgage to cover that 300,000 difference, and here you got that much nicer a home that you really preferred anyway, and you still feel like it's for cash because you don't have to make a payment. So it can help you extend your purchasing power to higher price levels if you want to do that.
That's brilliant. I love it. I love it. Art, thank you so much. You're just such a wealth of knowledge, and the creativity with this is just, it just makes so much sense. Thank you.
Sure. You're welcome, Jeff. Well, thank you everyone for watching this week's Mortgage Minute. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Again, enjoy the weekend. We're going to be cooling off here. Hopefully you're cool and comfortable wherever you are during this summer of 2025. So again, take care. We'll see you next week. Thank you.